My name is Laurence Slavin, and I'm a partner at Ramsay Brown, and I normally make a monthly podcast on what's going on in general practice and the wider health sector. And for this month, I'm going to just give a commentary on a talk I gave at Best in Practice on the 8th of October. The title is Self-Evident and in Front of You. And I'm just going to run over the talk, which was based on topical issues that I think need to be brought to everyone's attention. You probably know who I am by now, but this is our firm and this is me. We have a sparkly new website, which is definitely worth having a look at. And if you don't know that much about us, then if you look at the bottom of the of this list, there's an excellent testimonial, including one from a practice that we really helped get out of trouble. And it's evident how the benchmarking we do can really help practices who do need help. And the talk started by looking at benchmarking just to see where we are now. So I'm comparing our clients, this is GPs, our clients' information from last year to this year. The latest numbers that we're finalizing are for 24-25, and you'll see that profits are increasing and have increased quite significantly, actually. What is also interesting is that the median point has moved more. So the median point is closer to the average, and that's because there is more, I think, stability in general practice, and it's good to see that the bell curve is a little more bell-shaped than it was before. Importantly, income per patient has gone up. This is gross income before expenses, and there are reasons for that, which I can talk about on an individual basis. And when we look at costs, what is also evident is that costs have not changed significantly. In fact, possibly they've even come down a little bit from what they were before. We measure costs by being a percentage of your core income. If our denominator, which is the total income, and you'll notice on the previous slide that income per patient had gone up, then obviously the cost will go down. So that's probably more what this is about. But the important thing is that there's no great changes in these numbers. Just another couple of points I mentioned in my lecture. I think general practice is potentially in quite a good place. For 25-26, our analysis of the DDRB pay award, which was supposed to deliver a 4% pay rise to GPs, does that, and possibly a little bit more. So that, for the first time in a long time, seems to work. And the second thing is that what we are aware of is that there are more young GPs looking for partnership. It's something I haven't seen for a while, and that's really to be welcomed. And we have to keep our fingers crossed, that the changes that the current administration in the Department of Health are planning don't muck this up, because this is a good place that we find ourselves. If you're not a client of ours and you want us to benchmark your accounts to see where you would sit with our other clients, to see how you would fit in, if you send your accounts to me, we will provide you with a benchmark analysis, and of course it will be dealt with on the strictest basis, strictest confidence, I should say. So the meat of the talk, the first thing I talked about was about contingent decisions. This is really important and really significant, and this is part of the McLeod remedy. So the McLeod remedy, I'm sure you've heard of this 100 times by now, but in 2015, a new pension scheme was set up, and many GPs and consultants and other professionals were moved out of the 1995 scheme into the 2015 scheme. The 2015 scheme has a later retirement date, and a lot of people didn't like it. Some people left the scheme, but some people could remain in it if they were of a certain age. So an action was brought against the pension scheme, claiming that it was discriminatory to have this ability to stay in the scheme, and it was held to be true. So in October 2023, everyone who was moved from the 95 scheme into the 2015 scheme was moved back into the 1995 scheme for service up to March 22. After March 22, you're in the 2015 scheme. But because you've been put back into a different scheme, all the annual allowance charges have to be recalculated because there's different growth in the 95 scheme to the 2015 scheme. And that's what the RPSS is all about. That's what the brown envelopes are all about. And as you'll know by now, we have a joint arrangement with MediFintech, who are an excellent firm of public sector pension specialists. And they deal with the pensions and we deal with the tax, and it's all covered by the NHS pensions cost claimback scheme. So it has no charge. That's what McLeod's. And that's what you'll know about McLeod. But there's this new thing called contingent decisions, because some of those people who left the scheme after 2015 can now go back in and buy service into the 1995 scheme up to March 22. So this is a great opportunity. It's a great opportunity to put money back into your legacy scheme. And how do you do it? What we're suggesting you do is, the second thing you do on this list, having understood what it is you email the NHS pension scheme and you ask for your 05 service extract, which will give you a list of your NHS appointments, and it will also have gaps where you have not been contributing into the pension scheme. Once you've got that, you can apply for a quotation. You can see what it looks like on the right here. You can apply for a quotation, and it's not so easy to fill this in because there's only one form at the moment, and it doesn't distinguish consultants from GPs or anyone else. For GPs, you need to know what your pensionable earnings are, and you may not know what that is, so that may require some work from your accountant or from us to work that out. When you get your quote, just a couple of things. It doesn't take into account the annual allowance, so that you can't just look at that and make a decision. You need to take advice, and we would probably want to point you to our colleagues and friends at MediFintech for that. And this lists the kind of issues around it. You can pay the backdated contributions over a longer period of time, up to 60 months and possibly longer. And of course, if you've actually bought your pensions retrospectively, you'll need to have a new RPSS because there'll be a change in the figures that were originally issued to you under the RPSS. So you'll get another brown envelope. But there's just one thing in the middle here which I thought was really interesting. If you're an active member of the pension scheme, your pension scheme grows by CPI plus 1.5%. If you're a deferred member, so you're not contributing, you get growth at CPI. So you don't get the 1.5%. If you rejoin the pension scheme within 5 years of leaving, then the 1.5% that you've missed out on get backdated when you rejoin. So here's something. If you had left, or if you'd left in March 2015, you didn't want to be in the 2015 pension scheme, you've now got the opportunity to buy back 1 month in 2019-20 and 1 month in 2024-25, and you will have your 1.5% all the way through up to now. So you're buying back for the cost of just 2 months worth of contributions, you're getting your 1.5%. So this is just a way of looking at this in a constructive way. So if you think this applies to you, then you should talk to us. We know about this. We know that our institute have been told HMRC is going to be looking at personal expenses. It says here, sole traders, partners, landlords. And in my talk, I talked about a few kind of issues that perhaps people are not aware of. Tax is not straightforward, and some people make the mistake of thinking that tax is based on common sense and that they can almost second guess how HMRC will view things. And I wanted to make the point in my talk that you can't do that. So this is a question I asked. I asked if Dr. A visited the USA to attend a conference on family medicine in the USA with his wife, and he claimed a deduction for the cost of the trip, excluding his wife's expenses, and he gave the following reasons: to maintain his status as GP, to improve his reputation, increase his clientele. But he did admit he was going to have a holiday with his wife. Would HMRC allow 50% of the claim, i.e. just for him? Would they allow all the claim, or would they disallow all the claim? And one of the great tax traps is something called duality. So if you have a personal benefit and a business benefit at the same time, the whole expense is disallowed. It's not apportioned. And this is an extract from the judgment. And all the things I'm quoting here in this talk are taken either from evidence of cases or from HMRC's own rules. So this is not necessarily my opinion. This is actually just things that I'm repeating, which are valuable. So what the judgment said, it was quite clear it was his intention to holiday with his wife, and therefore the expenses were incurred for a dual purpose, and therefore the section so-and-so applies and prohibits the deduction of the expenses. So we got nothing. That contrasts with another case in which the claimant, who was the chartered accountant, so maybe he knew the rules a bit better, said that the any personal benefit was just incidental, and it was allowable. So you've got to be careful about how you do this. I also raised this question. Ryan's GP runs his own practice, signs up to a beginner's bookkeeping course at his local college. Although the course won't help him with his skills he needs as a GP, teach him how to keep accurate accounting records, which will help him run his practice better. And I asked whether or not the audience would think that would be allowable or not. And this is a new approach from HMRC. I think if I'd given this talk a few years ago, they would have said no, it's not allowable because it's a new knowledge, and new knowledge is capital, and capital costs can't be claimed. However, this is the HMRC's own internal business income manuals. Interestingly, that they publish their internal manuals on the internet, so you can find out what they're kind of thinking and what they're advising their inspectors. And what it says, the course will improve Ryan's record keeping knowledge, and he will learn skills which he needs for the purpose of running his business. The cost of the course is likely to be an allowable expense. So the rules are important to know. I threw this into my talk just because it's not particularly well known, and it's for really hospital doctors, junior doctors on rotation. So if you know registrars, if you know that you have, or you may know this may be you, or you have people who are affected by this. But basically, if you have successive 12-month contracts in part of your training, you can't claim any travel expenses. You can't claim you're traveling from home to hospital because you're employed. But there is an exception if you have a 5-year training program under a single contract of employment. In that case, deduction can be received for the cost of traveling between the doctor's home and the hospital. So this is a significant concession. If it applies to you, or you know somebody that it applies to, then please share this. I then talked about using limited companies. And as I said in my talk, a lot of accountants are shy about using limited companies. I'm not really. And I'll give you some reasons why. But first of all, what is a limited company? A limited company exists separately from you. It lives at company's house. It has directors who run it and they get paid a salary. And it has shareholders who own it and they get dividends. That's how it works. If you have part of your earnings, if you choose to do work through a limited company, it isn't your income. It belongs to the company. A couple of facts here. The company pays tax at corporation tax rates. These vary depending on how much profit you make, but for most people it's going to be 19-20%. So if money is going into the company, it isn't your income, then between that band of 100,000 and 125,000, at the moment you pay tax at around 60% because you're losing your personal allowance at the same time as you are being taxed at 40%. So if you're able to move money out of your name and out of your income and into a different vehicle, then it won't be taxed at that rate. We'll talk about how it comes out of the company at a later moment. If you need to keep your income below 100,000 for tax-free childcare, then the company can be helpful. It also reduces your pensionable profits and potentially annual allowance charges. Company cars. So I was given the example, if you were a GP, claiming 10% business use for your cars. If you bought a new electric car for, say, £40,000, you'd be able to claim 100% of the cost of that car under capital allowances, but it's restricted for business use. So you'd be claiming £4,000 of the £40,000, just the 10%, and you get tax relief at 40% on the £4,000, so £1,600 tax relief. If you have a company and the company buys you a company car, then the company claims all the cost of that car against its profits. So we've got £40,000, but of course at a lower rate of tax. But let's say the company is paying tax at 20%, you're getting £8,000 worth of tax relief, which is a lot more, even though it's a lower rate, than it was for income tax. What you have to be careful of with companies is that you have to pay tax on what's called the benefit in kind. So as a director, or higher paid employee, you have to pay tax on the benefit of being given a company car. And the way it's worked out is a percentage of the cost of the car. Now, there's a whole range of percentages from 3% up to about 37%. But if it's an electric car, it's 3%. So if it's a new car and it's £40,000, the benefit is £1,200. The tax you're paying that will be 40%, will be £480. So when you look at the tax difference between how much tax you're paying, £480, the benefit you've had, the £8,000, how much saving you had personally, the company car might be something worth thinking about. And the other thing I mentioned here is you can pay your children to help you. They have to be at least 13, and they have to do something of value. You can't just pay them money. But if you've got a bright 13, 14-year-old who's good at IT and can maybe keep your laptop clean, your computer system clean of viruses and updates, things as they go along, then you can pay them a salary, and that would be, as long as HMRC thought it was wholly and exclusively in the performance of your trade, you'd be able to deduct this, and unlikely they would have income that they would have to be declaring to HMRC. So this is an example, and again, I lifted this example. Perhaps I changed the kind of the profession here. This is an example I took from HMRC's own information. What do we think about this? X is a GP. He owns all the shares in his company in which he practices as a GP. All the income of the company is owned by him. He transfers his shares to his spouse. X earns £70,000 for the company. He takes a salary of £40,000 and he pays a dividend to his spouse of £30,000. And the question I asked was, do we think HMRC will say that £30,000 is taxed on X? In other words, come on, this is just an arrangement to avoid paying tax. Or HMRC will say, no, that's fine, the £30,000 income is income for the spouse. So this is actually an example from HMRC's own website. And you have to be careful when you're using companies, and that's why you need to take careful professional advice. HMRC can attack these arrangements under what's called settlement legislation. In other words, they're saying you've been inadvertently set up a trust here, and the income really still belongs to you. But in this case, the highlighted bits are the most important bits here. It says here that the transfer of shares is an outright gift between spouses, and the settlement legislation does not apply. We would not treat the dividend as the income of X. In other words, it is the income of the spouse. So that's really helpful. But beware of the bear traps. I also talked about something called family investment companies. So this is an alternative to trusts. Relatively new. Basically, you have a company that I talked about before, and you put your assets into the company. The company is owned by family members, perhaps several different generations, and each generation or each family member, will have their own class of shares. That's what they're called, alphabet shares. So which gives you the ability to pay dividends to those people that you want to pay dividends to, because you can pay dividend to the class of shares. Otherwise, you pay dividends to one class. The dividend has to be split between the individuals who have those shares. The question I asked was, so this was something from our institute, the Institute of Chartered Accountants England and Wales again, and a recent article in July. Their conclusion was that family investment companies are widely used and can be an effective solution for clients. Correctly structured, they're tax efficient, unlikely to be viewed by HMRC as aggressive tax planning. Well, is that true? So I've posed this question. What do HMRC think about family investment companies? Do they think it's an abusive tool to encourage non-tax compliant behaviour that we, i.e. HMRC, should challenge when encountered, or is there no evidence of non-tax compliant behaviour? And this is the notes of an HMRC forum, and this is an extract from those notes, which suggests that there is no evidence that the family investment companies will encourage, or there is a correlation between those who establish family investment companies and non-compliant behaviours. So they are a valid thing to look at. This was my last slide, and it's for GPs who own their own premises. I mean their surgeries when I talk about this. And I talked about something called business asset disposal relief. Business asset disposal relief is a clumsy title, but it's better known by you as entrepreneur relief. It followed on from entrepreneur relief, and before entrepreneur relief, we had something called retirement relief. So there's always been a generous relief for individuals disposing of their businesses until now. So what we have now is entrepreneur relief was 10% before April 25. Now it's 14%, and it's going up to 18% next April 26. And we have a budget coming up on the 26th of November, and we've been told very clearly it's going to be a tax rising budget. So the question is, if you are disposing of your surgery, disposing of any of your business assets, what could you do? What would be useful to know? Well, a few things here. So the first thing is that the date of disposal, which is going to trigger the capital gains tax charge, is the date of exchange and not completion. So you can exchange earlier and complete later. As long as it's not conditional, you can do that. The second thing you have to think about is, are you certain that HMRC will regard the surgery as a business asset and not an investment? I use the word trading asset, but business asset. If it's an investment, you're not entitled to the business asset disposal relief. You just get taxed at normal capital gains tax rates. And there's an example given in HMRC's own internal manuals again. Again, very helpful. So M leaves the partnership of which he's been a member for 12 years and sells his 1/3 partnership interest to the remaining two partners, making a gain of £250,000. This is an entirely consistent. This example is entirely consistent with what could happen in general practice. Throughout those 12 years, M has personally owned the property from which the firm has traded. So the surgery, yeah, that works. And then, but for the last 6 years, last 6 of those years, the partnership paid him a full market rent for its use. And what they say is, because for 6 of the 12 years he was a partner, full market rent was paid to him for the business use of the property, a proportion of the gain relating to the premises will not attract relief. If you get rent, it's an investment. If you get a share of profits enhanced because of this, it's a business asset. I hope you found this helpful. I hope there are some few tips in here that might be relevant to you. You know where I am, you know who I am. If you need any more advice or support, then please don't hesitate to get in touch.